Avila Finance students, hope everybody had a great weekend. Looking forward to the coming week. A little bit of a rough week in the market. Saw some drop in the stock market, especially because of earnings that were released recently were not as great as expected. So a little bit of correction going on in the market. So we'll see how things go this week. So in terms of this week, we're going to get into what I call the meat and potatoes of finance, and that's the time value of money calculations. And I want to let you know that I put a example out there that you can watch to help you with these calculations. So in this chapter 5 and chapter 6, this is where I really encourage you to use Excel when submitting your homework, because I want you to develop this skill set. This is a tool. When you look at some of the time value money calculations, I think of payment, future value, present value, number of periods, the interest rate. I want you to be able to kind of interchange any one of these and say, hey, I feel confident solving for any of these. Yes, there are calculators out there that you can go online and put information in. It will tell you, what your future value would be at a given interest rate. But it's not always going to tell you what happens if it's monthly or compounded quarterly, or how does this change things, or what is your need. So this is like the foundation for finance, and it has tremendous personal financial benefits too. That if you know how to use these things, you can say, hey, I can pull up Excel, and if I decide that I want to buy a new car at this given interest rate for a 60-month loan, I can figure out what my payment would be, and it's going to help you make decisions. It's also going to tell you things that if I plan to retire in X amount of years and I need at least $1 million, how much based on a given interest rate do I have to put in each month? So examples of future value of annuity, present value of annuity, and even after retirement, how much can I take out each month? It's just a payment too. So a lot of practical applications. And we have to understand these tools because in corporate finance, they're going to use these tools also to help them make decisions about cash flows and when they're going to occur. And eventually we get into net present value, internal rate of return, and payback period. Is it meeting my opportunity cost? Can I take on this investment based on a given risk? So again, I put a video out there, read through the books, the PowerPoints, but make sure you feel comfortable with these types of calculations because you'll see them again on the test the next week. And I strongly suggest, that you submit your homework this week in Excel. Do email me if you have any questions about the problems. Okay, so chapter 6, we're getting a little bit more of risk versus return, especially looking at different scenarios and what's going to happen to my portfolio. So it's going to get into the concept of historical rates of return, also expected rates of return, and then eventually you're going to look at this chapter to kind of figure out how to calculate variance. And if you take a square root of a variance, okay, that's what we call a standard deviation. So standard deviation tells me something about the volatility of these returns. Is it a small standard deviation or is there a big standard deviation? So if there's a big standard deviation, that means that it's going to be more risk. And another thing you're going to look at too is beta. And what beta does is it looks at the return for, say, my stock, say that you're looking at IBM, and here's the market. So the market is the independent one that's constantly changing, and then here's IBM returns, that's going to change based on the market. So if you have a beta equal to 1, it says, hey, if the market goes up 10%, then my stock returns, in price and dividends goes up 10%. And if the market goes down 10%, then my stock goes down 10%. And if you have a beta equal to 2, what says if the market goes up 10%, then my stock goes up 20%. Vice versa. If the market goes down 10%, then my stock's going to go down 20%. So there's a much higher risk associated with that stock. If your beta is only equal to 0.5, it says, hey, it's going to move less than the market. So it's kind of protective. But you have to take these things into consideration when we're trying to figure out what is an appropriate price that we pay for the stock, what's an appropriate rate of return. So you're going to investigate something called the capital asset pricing model. This was founded by William Sharpe. He won the Nobel Prize in Economics for this calculation. Essentially says, hey, I have to take some risk-free rate plus beta times the difference between the market return and the risk-free rate. So obviously the higher the beta is, the greater the required rate of return on that particular stock. It doesn't mean that that stock is going to give you that rate of return. It's just an expected rate of return that somebody that's investing in this, and in theory, then that price in the market should reflect that somebody's going to anticipate that they're going to get this gain from investing in riskier stock. And the authors also go into what they call about systemic risk and unsystemic risk. The unsystemic risk is company specific, that I can diversify away. If I get maybe William Sharp started off his early theory, maybe about 20 stocks that are of different risk. You can't have all tech stocks in your portfolio, but it says if I can have some of varying risk in different industry sectors, then I can diversify all the way to that company-specific risk. And then it's just less to systemic risk. So if the economy doesn't do as well, or as we saw the past week, that the market adjusts, well, there's nothing you can do about that. Your overall portfolio is going to go down. But by diversification, you can help eliminate some of that risk. And that's what a lot of portfolio managers do on certain types of funds. So, okay, well, that's an overview of this week. If you do have any questions, do email me. But do read the chapter slowly, watch the videos, look at the PowerPoints, jump in there early. Make sure to jump in there by Wednesday for the forum discussion so you can allow some others to look at your post and give some feedback to those posts. But enjoyed reading the forum discussion post, so just good job with that and just keep that up. So have a great week. Hope the markets do well, and we'll talk to you online.